Good evening, everyone. Good to see everybody here. Good to be in London. Got here last night, leaving tomorrow morning. That'll give me a lot of time to really breathe, but that's just the way it is. Let's just talk about the CMT program a bit. Tyler and everybody at the MTA wanted me to talk about that for a little while. Anybody enrolled for the program this weekend to take the exams? Oh, so everybody here is a CMT? Great, we got some CMTs in the room. Basically, just wanted to talk about a couple things. I'm just going to speak from a few notes I put out here about the CMT program, about what's going on. Right now, I'm on the Board of Governors, so I'm the current chairperson of the Board of Governors for the CMT program. And basically, there's a lot going on. First, the growth of the program is getting exponential, and there's a lot going on the surface. We just hired about maybe 9 months ago a CMT program director, and the exam is just becoming stronger. It's becoming a little bit more difficult. Why take this examination? Well, it has a big differentiating characteristic. One is it has a FINRA exemption. And it's one of the only exams out there that has that type of exemption. The second thing is, basically, it's a good way to solidify your knowledge of the subject. It's a good way to professionalize your interest in technical analysis, which is the primary reason why I did it. I started off in the industry, more, believe it or not, I started off as a cold caller in a boiler room, but, then somebody brought along a chart. My dad also was a chartist, so I knew about charts. I've been exposed to charts all my life. But I just saw this, and I'm like, wait a second. This is on the same level as a CFA program, as defined by the U.S. government. So basically, the same exemption for the Series 86 that exists for the CFA exists for the CMT. It's a big deal. Rathbach and Poor and a whole bunch of other people had a lot to do with that. Basically, what they said to get this done was earnings can be revised, but price action cannot. I mean, look at the stub quotes that were hit on the flash crash. Those are still on your charts. I put my hand over them when I look at the charts, but they're still there. So basically, I mean, the best way to think about this program is, if you want to, if you're looking to get yourself on the map as a technical person. I mean, all these designations are great. I mean, I think they all have a lot of value. But the CMT program at this point is on a steady growth trajectory. It has good, government recognition, not only in the States, but good global recognition as well. So, I think the three questions that most people ask about it is, how hard is it, how much does it cost, and is it worth it? Well, level 1 isn't that difficult. It's definitional. You could pass that with 20 hours of study. Level 2 requires a little bit more. You're starting to do a little bit of the synthesis of the ideas. You need about 40 to 100 hours of study. Level 3 is challenging. 50 to 100 hours of work needs to be done. It costs, after books, the cost is about $3,000. I think the cost is going to go down because right now the Board of Governors is working on a bunch of things to drive the cost lower. One of them is our own curriculum for the program. We think it's worth it. This test is psychometrically reviewed, so it has validity based on psychometrics. The questions are graded 4 times, so it's very diligent the way we go through the process. There is a performance review that's statistical. It breaks it down so you know what you need to work on if you fail it once, and know what to do the next time. Basically, I just wanted to give you a couple details on that program, just in case you didn't know about it. There's a lot of good text in that book, in that curriculum. I actually saw the curriculum for some of the programs over here, and I'm glad you guys have Ikimoku charts on there because we don't have that yet on the CMT program. But so I thought that was fantastic. But I just wanted me to say a few words about it. I think people here are probably more interested in charts that I'm going to go over, so I'll just leave it at that. If anybody has any questions on the program, you can reach out to the MTA office and they can provide you the details. But again, put it this way. It's growing fast. the exam's only going to get harder. It's going to be an exam, and the exam's only going to get better. We're going to have charts on there that are clear to read. In the past, that's been an issue. We're resolving that. So there's a lot of good things happening. CMT charter holders are taking the exam, which is interesting. That's the biggest growth area. When I go out on the road and meet portfolio managers, guess what? A lot of them have the designation. So it is becoming a very diversified designation, meaning it's not just technical analysts like myself who have it. There's lots of people who are taking it, lots of people for us to talk to, lots of good counterparts, both buy side and sell side. Does anybody have any questions on the CMT program? Just real quick and dirty, I didn't think so. So let's get on to the meat of the presentation. And every month I put out this big chart book called the monthly presentation, and has a lot of timely charts, a lot of interesting charts that we review when we go out and see clients. And this is a PDF of that. And the one thing about the chart on the cover is this is the chart we always put on the cover. It's basically the Dow Jones going back to 1885. And why do we do it? It just shows you a couple things about markets. First, they tend to trend, go through periods of trend, they go through periods of range trade. The financial advisors in the brokerage system at Merrill Lynch love this chart. It helps them tell the story that markets don't go up in straight lines. The one very interesting thing about this chart is when we went to a new publishing system, all the annotations on the chart disappeared. It went out. I had a full email box, a full voicemail box from advisors saying, where are the boxes on this chart? I mean, this is what I use in my business, talking to clients about markets. So what are some key charts that I'm paying attention to in coming months, this quarter? I mean, as of what this publication, the S&P was breaking down a bit, still into a cloud chart support, as you can see right here. This is still an uptrend. It hasn't been reversed yet. It's been challenged. We reclaimed the 50-day moving average. Right now, we're stalling at resistance around the 1872 to 1884 area. I still think there's potential to get the S&P to a marginal new high, if this market does rally a little bit more here in the May. But what I think is going on in the marketplace is a regime change. The NASDAQ has lost its leadership status and clearly, in my assessment, has moved from a buy dips to a sell rallies mode. The major differences between this chart and the S&P is you broke the June uptrend, you broke the cloud chart. On the chart on your right side, which is the relative, has broken down and continues to break down. So the NASDAQ has lost leadership. The risk is the NASDAQ can't go to a new high, and the risk is the NASDAQ can break lower. When I talk to people in our system who own biotech names, and I talk to our trading desk, they're saying that they haven't seen the broad-based selling from the clients that have held those stocks. It hasn't happened. I get calls from financial advisors. What they're saying is, I bought Stratasys at $105, it's $95 now. I'm not selling it until it gets back to 105. Key point is, it's interesting, this market, the stock actually did get back to 105 after that conversation. I don't think he sold it. But the bottom line is, I think this market has been very forgiving. I think it's becoming less forgiving. What I see in this market is a shift, a regime change. And this happened in 2011. These two charts compare now between 2011. So your left side chart is now. The right side chart is 2011. What are we looking at here? We are looking at the S&P 100 relative to the S&P 500 index. We're looking at in both time frames. So you can see what's going on. Right now, you're as of this publication, you're breaking through the trend line. And probably today, I would think, at this point in the session, you're probably doing, Apple is up a lot. Apple has a 4% weighting in the mega cap. This is probably going up. 2011, you broke out from this trend line, then you broke above the 200-day moving average. And what happened during that environment? The market had a decent correction, a decent pullback. On an intraday basis, it was 20% in the S&P, 22, I think, in the New York. This year, this is coinciding with the midterm year election pattern, which I'll get to in a moment, which a lot of people are talking about. It's also sell in May and go away, and that's been beaten to death by the media. In fact, there was a big argument today on CNBC between the anchor and the guy he was talking to about sell in May and go away. He says the market's not down during the May to October time frame. I'm like, yeah, they're right. It's not. It's up about 2%. But that pales in comparison with the rally that you would get by buying in November and selling in April at 5%. So there's and the risk of 20% pullbacks during that 6-month period increases from an average of about 11% to about 17%. So a much bigger risk of a 20% drop. You overlay that with midterm election patterns and things like that, and the market is positioned for some sort of interruption. Even if it doesn't get an interruption, I mean, there's trends that suggest that mega caps are a place to go right here. A lot of stocks have broken out on volume, and this is not just now. Some of these things happened a month ago. I have a screen that I use, to combine price and volume screen. It's called 90-day breakouts, 90-day breakdowns. Basically what it is the stock going to a 90-day new high or low with volume confirming the move. What is the volume trigger? The volume needs to break above a Bollinger Band, a 1 standard deviation around the 90-day moving average. So if you get price moving to a 90-day new high or low with volume going above the +1 standard deviation, that hits the screen. What I've discovered about this screen is it helps me really pick out pockets of the market that should move higher or lower. Now here's the key point. In my toolbox, my favorite tools are absolute price trend, relative price trend, and I look at volume as well. But in a raging bull market last year, some of these 90-day breakdowns actually worked on an absolute basis. You know, Walter Energy had one. CLF had one earlier last year. These stocks all went down. What about the ones that didn't go down? Because I'm sure a lot of these 90-day breakouts did not do that well in a raging bull market. And you're right, on an absolute basis, they went up. But when you look at the relative price charts versus the S&P 500, they underperformed drastically. So what's the value here? The value here is really more using the price and volume screen, not only for absolute trading, but also for, wait a second, what's going to work well relative and absolute. So if you're a fund manager or a portfolio manager that you know, say for instance, you're getting a lot of 90-day breakdowns in technology. You know, if the market starts to go up, there's a better than average chance, I think, of those stocks performing, given the overhang that the volume on the downside has created. So that's what I've discovered. But back to this chart, it's showing you that we are starting to see a shift into mega caps. What helps me confirm this is, go to the next page, you can see small caps, regime change, chopping out versus large. So you got the Russell, relative basis versus the S&P, left side. Yep, left side is now, right side is back in 2011. You can see here, I should have probably drawn this here, but I guess I can't. Yeah, see there's a shoulder there, a head there, a shoulder there, broke the neckline. Head and shoulders top. Here it's more of a double top. And this is actually down, what it has done since then is moved here, rallied back into the trend line, and actually I have a chart of that more recent, I think, right there. So you can see what has happened here. The small cap lows have continued. So I do think the small caps are the message here is the market's becoming more defensive under the surface. Last time it happened, it led to a meaningful pullback or correction. So what have we talked about so far? First, S&P stronger because large caps are doing better than most other areas of the market. Mega caps are starting to outperform large caps. Small caps are starting to underperform. NASDAQ has been underperforming. What's the message here? Well, the message is the market can go through a period of consolidation or dislocation. People will say, well, the advanced decline lines keep going to new highs. Well, I'm like, well, if this trend continues on these indices of 2,000 stocks outperforming an index of 500, chances are your 80 lines are not going to stay in that bullish position for long. So these are some charts I'm paying attention to for the next quarter. Another factor is the midterm election, and this is very tongue-in-cheeky. We are here. April peak is typically what you get in the midterm year going back. The first midterm year when the study is 1929. Now this is monthly average prices. So basically, I mean, you know, that's what it is. That's how I looked at it. So basically, what this is setting up to pull back into September, good rally into year end. regime change chart. What is a confirmation of this phase is you've got to get the VIX through that range. This rally from late 2012 has been built on complacency. Complacency over easy Federal Reserve policy. Obviously that's changing. I think you're getting more hawks on the Federal Reserve board right now. Taper has been in the cards. So I think this is where we're at. But the one funny thing about it is the short end of the curve is reflecting the tapering. 2s and 5s look like their yield trends are more constructive. I don't have charts of it, but if you look at each Ichimoku clouds, which you guys probably know more about than people in the States, 5s and 2s are above their clouds, 10s and 30s are below their clouds. It kind of tells you something about the yield curve, you know, that it's flat. Long story short, take a look at yields. At the beginning of the year, the S&P was at a new high. Yields were 3%. S&P went to more new highs in 2014. Yields topped out at 2.8. The message there is there's some doubts about the economy. Yields heading lower is another risk factor for this market. So I think near term, yields can go lower, stocks can go lower, VIX goes higher. We follow this pattern. This is basically the reason why I think a pullback or a disconnection this year is more of a consolidation rather than a major top. One is, you know, big picture breadth indicators like advanced decline lines have confirmed the rally. I think it's just a pullback within this uptrend. Presidential cycle year 3 is much better. Here's an objective study on presidential cycles. I highlighted the midterm year. What's different about the midterm year than all others? What I'm doing here is looking at the S&P daily. I'm starting the year off flat, meaning intra-year pullbacks. I don't care what happened before January 1st. I'm looking at intra-year. So say you just say, all right, I had a good year or a bad year the following year. I'm starting from a blank slate. How often do you have an intra-year pullback of 20% or more during a midterm year? It's about 43%. The average pullback is about 20%. So your average pullback during a midterm year going back to 1928 is 20%. Median is 19. So there's no major outliers there because you only got about 21 observations. But the one thing I will point out is, since we are in this, what I believe is a secular bull market, I just think we get a cyclical consolidation against that. I think this is a pullback that can be bought into if we even get it. I mean, this has been a market that, what are investors expecting? They're expecting two things, short and shallow. What we probably get is long and deep. Long and deep means trading range. It doesn't feel like it go down a lot, but within the trading range, you can have a range of like 15–20%. And occasional spikes that get the market down. I think that's what we're more positioned for here. Some people would say that that's strange, but it hasn't happened in a long time. Most people are conditioned. And that's what that VIX chart tells you. The fact that the market pulls back and the VIX can't get through 21, 23 tells you that the participants are conditioned. For 6 to 8% declines, nothing more. People have forgotten that the average intra-year pullback is that number right there, going back to 1928. Now, obviously, if you look at this table here, I'm being honest. Where did all the 90%, where did all the pullbacks occur that were 20% or more? I mean, a lot of them occurred in the 30s and 40s. It wasn't until 2000 that you saw a rebirth of 20% pullbacks. 4 out of 10 years, from 2000 to 2009. So, so far, you don't have any here, except on an intraday basis, and this is closing price basis. So, I'm not in the camp that we haven't had a pullback in a while that we're going to get one. That's not my mantra. My mantra is that we are seeing some deterioration. We're seeing leadership changes. We're seeing defensiveness under the surface. We're seeing high flyers break down. I don't think we've seen the capitulation. If you look at volume on a lot of these charts, there's no spikes. There's no spikes on these lows that happened. Here's another factor, decennial year 4. Combined decennial year 4, which is done on this chart here. Where's my little box? But basically that's the chart I'm looking at. Combining 2 cycles, decennial and presidential year 2, they're in sync. So what it tells me is the market pulls back, consolidating. I'd be looking to buy. Here's just some broad brush strokes. This is just really big picture type of simple work. Basically a trading range breakout. 2330 is what it projects to. I see a lot of similarities with this breakout. I mean, maybe get a throwback like that breakout. It wouldn't surprise me if this market consolidated this move. Bottom line is, macro perspective, 2013, secular breakout, presidential cycle, some of the things that we're seeing now in the rotation suggest cyclical consolidation, resistance, reverses rolls, and is key support. So I'm not ruling out, moving down towards 1600, 1500 range. I'm not ruling that out. I can't. It has happened in the past. Here's how I get to that 2370 range. I mean, it's just using the breakout point. But the key point is, what happened when you got to it? The market kept going. What happened when you got to it? The market kept going. That's what a secular bull market is. Here's the 1929 peak. It did not offer any resistance whatsoever. So the bottom line is, go to the next chart. This is 1950. The dashed line, this is now. Breaking out right on schedule. Not ruling out a 1980 style moment, which would occur along with presidential cycles. So these are what I'm thinking about for the next quarter, maybe a little bit longer. Lining up the generational lows also would suggest that this rally is long in the tooth. It looked just like the rally from 1942, but has extended further. And the primary reason for this is the breadth has been strong. These are just a history of cyclical pullbacks. They can happen. They lead to pretty good retracements against the trend, but they're only cyclical, not secular. Against the trend's the key point. That's what I'm focused on. And these are just macro charts that I like to look at. Yes, fundamentals, P/E ratios. Just something to think about. Food for thought charts. Chart on the left side shows the trailing P/E for the S&P 500. The top chart shows the Dow with the trading ranges we highlighted on the cover. What's the key takeaway? What do trading ranges do? They compress their valuations. What happens when you break through the upper end of the range? Look where your valuations are in general. Low end of range. Breakout top side. Breakout top side, lower end of range. Breakout top side, lower end of range. Obviously this was a huge spike on the chart due to the negative earnings and all that, but again, I mean that's what the tendency is. The Shiller shows another pattern too. Shiller is basically the average inflation adjusted P/E ratio for the previous 10 years. So big trend line breaks, and this is a 20+ year trend line break leads to a big raging bull market. Had a false move there, but again, a big break leads to a raging bull market. Big break leads to a raging bull market. Big break. My gut tells me, this is a good sign. I mean, maybe you do something like this for a little while and have to draw another trend line, but I think the message is clear. Valuations got compressed, and the market leads valuation. So I think you get PE expansion. That's the message there. So the valuations are cheap enough where the market does pull back, I think, to be buyers. Here's the AD lines. They confirmed the highs not only in early April, but the advanced decline on the S&P actually went to a new high. It did on the New York Stock Exchange. Now, one thing about this is, the same thing happened in 2011, which is interesting. Just as the ratios I was pointing at before were turning. Let me just go into intensity, price momentum. I mean, this stuff everybody knows about, so unless anybody has any questions on it. I'm going to go to another report here. The daily that was out today, just to show you this is mega caps versus small, doing the same thing in 11 as well. So this is basically the largest of the large versus the smallest of the small. Russell top 50 versus Russell 2000, same story. more confirmation. That's what I like to look for. I'm in the mega cap, so these are underweighted stocks. So another tool in the toolbox is what's underweighted by fund managers. Triple M. Well below benchmark position. I've been on this stock. This has been on my list on this base breakout. But I'm still looking for 150, 155, 160, somewhere around there. It's underweighted. Mega caps are generally underweighted. Caterpillar, same story. And this is underweighted relative to the benchmark. What does that mean? That means if one is the benchmark weighting in stock, mutual funds have a less than one reading, and in most cases these stocks is below the 50% below their benchmark. Meaning that if these continue to work, there's a catch-up trade that fund managers have to do. Caterpillar, same thing. Here's what I talk about when I like relatives. This relative you would look at and be like, wait, it's not new highs. But it's enough for me because it's confirming this base breakout. So you have a 2-year base breakout on Caterpillar. It looks really good. 90-day breakouts actually started occurring before the base breakout. Here, and I actually wrote about it before. Right in there. Well, not, so that volume screen hit in advance of the price breakout. Volume gave you the clue that there was actual buying going on in the stock. The relative just started confirming, but I was being proactive because I noticed that this was a basic year too. Moving averages started to turn up finally. So that's a 250 day. I'm not, a lot of people say, why you use that? Everybody else does. Well, everybody else misuses it. You get people calling you up on the phone in a panic. Oh my God, my stock broke below the 50-day moving average. I'm like, big deal. 50 days rising, give it a couple days. And sure enough, I'm calling you back 2 days later. Oh yeah, back above the 50 day. It's really more about the trend of the moving average. Most people don't realize this. Most people just pull it up on their screen. The average person, maybe I shouldn't be talking. I want them to stay that. That helps me. It's like the Connie Brown Stochastic Default Club. If you ever read Connie Brown's book. That's what they do. Look at the default. So if they break the 50-day, they say, I'm out of it. Break the 200-day, same thing. A lot of times the stock can break a 200-day moving average. That moving average continues to rise. The stock doesn't, go, stock regains it. Right here, it did that. Obviously it's not perfect because you've had range trades around the 200-day moving average, but that's a moving average is a trending indicator. So it helps to define it with the trend. But Caterpillar basically looks solid. I like relative charts that have underperformed for a while and then turn. What we're having here is the 200 starting to rise. So I think we have changed leadership in the stock. This is a stock when this started breaking out. It looks like this. That's what Caterpillar looks like. It looks like Triple M, back in early 2013. The one difference, though, is Triple M was all-time highs. We got resistance that contended, 115, right around there. But still, that's a pretty solid game. ExxonMobil's another one, trying to turn relative. I'm a little bit early on this one. But this is a huge support. Stock's closer to support than resistance. This base, I don't know if you ever get up to this level. Is it possible based on the chart? Sure, definitely. More reasonable is probably these trend lines in here, 110, 120. Probably not ruled out. General Electric, underweighted also. I don't know what it did today. There's a lot of merger news and things like that. But again, it's holding this moving average, relative bottom off of the support that goes back, 3 years almost. Why not give it a good hard look for a period of outperformance? This is range bound, so my gut tells me that since this is more of a range bound relative, you probably go through this moving average and up to here. So I think that tactically you could probably do well in this stock. Absolute. Wouldn't surprise me somewhere in the 28 to 29, 30. This is just some ways I like looking at the market. This one's a little trickier, but I do like the absolute chart of McDonald's. And it has acted well on poor tape. But look at this, big support from 09, big chart level coming around there. Relative it's hard, but I put it in here only because I just like the way the absolute is. And if I had to pick something in discretionary, because I don't like discretionary at all right now, this is one name I would go with because on relative discretionary, it's actually outperforming drastically. Sometimes when you look at these big picture charts, it's just about support and resistance. And with McDonald's, what I've told clients for the last 6 to 9 months is buy at 94, 92. Sell it if it breaks below 90. You know, ExxonMobil was buy 90 at 85, sell it if it breaks below 85. Sometimes from a charting perspective, forget about all the other indicators in the noise and just say, look, mega cap, that's important. Focus on $45 on Citigroup. That's a very important level for the market. Let me just show you what some of these 90-day breakouts and breakdown charts look like. I mean, obviously this one happened a while ago. This one's a little bit more extended, but it's confirming this move and trend. You know, this one's a good one. Just started breaking out. This is HCA Holdings. Basically, you can see here, Bollinger Bands on the volume, breakout, relative breakout, confirming, absolute breakout. So HCA is a name, actually I highlighted it last week, believe it or not, in our weekly comment. Because I saw this triangle pattern, and I liked the way it was trading close to the support. The relative was also quite constructive too. So I thought this was an interesting name even before this happened. Because I published on that last week. Like Point Hospitals. I mean, this relative is just dead, but maybe it comes to life here. Again, I mean, one thing I have noticed, and this is actually a pretty interesting takeaway, I think. Fundamental analysts, they have two schools. Well, just a simple one. They got value investors and growth investors, or momentum investors, right? Technicians have mean reverters and trend followers. Now, I'm more of a trend follower than a mean reverter. One thing I have noticed is that mean reverters have muddied up many breakouts from basis. This is an example of this. LifePoint broke out earlier this year and moved to the upper end of its range, never invalidated the support or the moving average. Traditional chart terms, Edwards and McGee and all that other stuff, you're not supposed to go into the breakout. But a lot of stocks do. More so than when I first entered the business, you know, in the 90s. Well, the 90s was a raging bull market. Obviously, breakouts probably do not have to retest as much. But what I am noticing, stocks break out, and then they go back in to the prior range, but they hold above the last major higher low within the prior range. So I've noticed that these mean reverters have actually been doing me a big favor. You know, the stock trend works, and you do have a valid big breakout, which this one remains to be seen. I mean, I obviously would like to see the relative look a lot better than it has. Basically, it just means if this goes up and the market goes up, it performs in line with the market. But given this is healthcare and not biotech, chances are it can outperform in a tough environment. But the bottom line is, these mean reverters have moved things back into the ranges to give me a better entry. Scary, because you feel like you're invalidating the breakout. But I've seen this happen on this particular stock. There's others I could talk to. I mean, here's one that I've been bullish on. And granted, this is not the first 90-day breakout. This is the second. The first one is right there. So when I see something, clicking on 3 cylinders is basically like, okay, what do you got here? You got absolute price performing well, coming out of a bottom. You got relative price confirming that bottom. And you got volume confirming the breakout. Does volume always have to confirm the breakout? No, of course not. I mean, you could probably find some charts that have this without the volume on it and do just fine. But I kind of like doing it with the volume. You know, it has worked well for me. So, from a trading perspective, even if the market goes down, you know, this does look like it's positioned to outperform because this is a major turn in trend from down to up for Weatherford. And energy in general has a lot of stocks that look like this. Breakdowns. Amazon, big one. And this is not the first time a 90-day breakout down appeared. Technically, this was one, no, this was one right there. So, it's basically right in there. This is another one that just happened. What's going on with this chart? Well, this gave you tons of clues. I like gaps. Gaps are big for me. I forgot to mention that on our interview, by the way, but gaps are important. You can't dispute it. It's there. It's resistance. It's support. It's a place where you put a stop above or below. It's a place where, I mean, I just wish I was more aggressively shorting this stock, which we have a buy rating on, but it's hard for me to do that. I can and do because our analyst has a buy rating, underperform on Microsoft. I've liked Microsoft for a while. He lives with that, and I live with him. So we get along okay. Nice guy. I'm a nice guy. We understand each other. Come from different ways of looking at things. But anyway, this gap did not get filled. It traded within the gap, and there are clients that actually listen to me saying, "Okay, stock's down, testing support. I don't think it gets through the gap," and it rallied a lot to try to get through that gap. You have another gap here. Didn't get through that gap either. Now you have this gap. This is now where your stop is. Gets lower and lower. So what do you call a stop? A stock where your stops get lower and lower. You call that a trade that's working, on the downside. If you're doing it on the upside, you're doing something wrong. You're increasing your risk. Essentially, the relative is broken down in advance of the absolute. So this trend line probably fails to hold. The volume is just increasing on the downside. So I think Amazon is a problem. Not the only one. Netflix rallied into a resistance and came down last Tuesday. I saw that gap up, and I'm like, God, now I'm talking against my gaps. But I'm like, look, this is Netflix. The stock is a high flyer. The stock is running into resistance exactly where it should run into if it was to develop a head and shoulders top. I would fade it, and it worked. There's another one. I mean, geez, do you buy it? Do you sell it right here, right now? I mean, God, you can. I mean, there is risk down here, but it's hard. You give this to a portfolio manager saying, where were you when it was in here? Well, this pattern has been bearish for a long time. It's been a downward sloping trend. The moving averages are rolled over. This writing was on the wall. I have not liked crude. What do you do with it now? I mean, this is where you start to get low volume rallies against that trend, flags, things like that. That's what I would do. That's what I would look for. But this is a big breakdown. Honda Motor. This triggered a 9-day breakdown right here. And also in here as well. I think this one continues to go down. Japan looks lonely. Yen looks like it wants to rally versus the dollar, meaning yen could go in the mid-90s. Honda Motor. Price, volume, relative, all confirmed. Relative trend. There's another way of looking at divergences, by the way. I'm going to walk over to the chart because I just think it's really cool. But just look at what happened here. You rallied all the way up to here, tried to break out, and I don't know what I did on that breakout. I can't remember. Maybe I was bullish, but I wasn't bullish for long if I was, because this relative did not break out. Big diversion. So if there was an indicator to create off of this, it's basically just create an indicator, just taking a positive percentage value off of that, or something along those lines where this is a big divergence. I mean, you couldn't get this relative ratio above a moving average. I mean, that's big. That tells you something. That tells you that the leadership of that stock is gone. It tells you that if that stock keeps going down, there's going to be benchmark, selling. People are like, I got to sell this because this is one of the laggards that is causing me to underperform my benchmark. I mean, that stock is scary. Pandora. I actually thought this one was a better looking one within the space, but I was waiting for it to prove it to me. And one thing I like to do when stocks are, because the 200-day was rising, right, and it got back above it. But the other thing that didn't happen was you didn't break through the downtrend, and you didn't break through this chart level, which has held. So, this one's down for the count too. Relative comp confirming the absolute. And the other thing that was a sure giveaway that this 200-day moving average wasn't going to be sustainable is the relative did not break above the 200-day. That's what the NASDAQ did. That's what the Russell did. That's why I'm nervous about the market. These high flyers are not going anywhere. Maybe we got some capitulation in here, given the big volume level. Maybe it rallies against that. But this gap, if that's resistance, I would look to sell it. It's a potential short candidate within that gap. That's a real gap. It shouldn't get filled anytime soon. Yelp is a similar story, except there's no gap left, but the same story. 200 held, downtrend line held. no relative strength. I mean, these aren't done. They can't be. I mean, if they are, then I'm wrong. And you know what? That's fine. You know what your risk is. You see this little dashed line up there? That's my risk. You know, on a big high-flying name, you know, a big beta name, I mean, you know, that's what you got to do. So, tactical rally against that. Put a stop above 68, looking for 50 to 40s on this. This should change the ticker and change the Y to an H, because that's what it looks like it means. Sorry, not a good joke. I wish I was better at jokes. Basically, and then another big thing is relative ranks. There we go. Relative ranks I like to do. These more tactical, but you can see discretionary is pretty limited, energy is pretty high, financial is pretty low. These are the top ranked stocks. Healthcare low, industrials actually lower than I thought they would be. Information technology pretty low, materials relative to the sector is actually pretty good. Utilities is high. That's where relative leadership is. Then you go down here. I mean, discretionary is a disaster. Staples, energy, doing better. There's fewer on the relative weak list. Financials is mixed. I mean, you got some looking about an equal amount actually on each list. Healthcare is a problem. Biotech is the problem. Airlines is interesting because you got a lot of airlines on the best, airlines on the worst. I mean, there's air trades in there potentially. Tech has a lot of issues. Materials, metals, and mining. It's more about gold. Being weak, still relevant. No utilities. Market's defensive. That brings us to today, and you're probably sick of this. Sell May and go away. I talked about the stats earlier. I mean, basically, I just looked at basically the view is, midterm year, that's what the pattern is. Midterm year is great because it's sell April, but you can buy this market anytime September through December. This is supposed to be December as it is on the cover, but I was up at 2 a.m. on Saturday writing this. You know why? Because I was coming to London, getting in, and I needed to get some sleep, so I didn't get any sleep Saturday night just so I could fall asleep at a reasonable hour last night. Yeah, that's being a sell-side analyst for learning these tricks. So you can see May to October, positive, about 2%. November to April, 5%. Midterm year, it's not the worst period. The worst period is April to September, you're down. And look at this, positive 10% returns. Starting in September, this is 6-month returns. That's huge. Percentage of times with corrections, or up over the month. Look at this. Midterm year, second half, it goes up to 80 to 85% of the time up. Much better than average. So the conclusion is, if you follow this overlay, it suggests that sell May and go away could be weaker this year, but that weakness creates opportunity. Let's see. I just want to show you something that's more interesting. You saw that already. No, that's the NASDAQ. I'm sure this is going to become consensus. We'll see what happens when that happens. But I'm just seeing a lot of other things developing there. But I wanted to just show you my volume stuff. That's interesting. What is VIM, or the volume intensity model? Well, what we're doing is we're looking at accumulation distribution, how we're defining it. We're defining it as volume on the upside relative to overall volume, and volume on the downside relative to overall volume. So what that means is this number is telling you the same thing no matter what the overall volume level is. It's basically a volume internal number. So the S&P message is this: accumulation is falling deeply. But the indicator is bullish because your accumulation is above your distribution. It's not strong. The other thing is this: the market has bounced off this low. Accumulation, distribution's gone down sharply. Not much of a rise in accumulation, unless I tell you. Well, it gives me guidance to say that the rally is not really driven by buying; it's driven more by an absence of selling. So this is NYSE, bullish. did it for the NASDAQ. Well, distribution is above accumulation. Distribution has dropped substantially. Accumulation, there's nothing going on in the NASDAQ. So up volume in the NASDAQ, relative to overall volumes, using a smoothing factor, not responding at all. My gut tells me these two kiss, as a technical term. They kiss, but they don't make up. And basically, this probably goes up, this probably goes down a little bit more. The one thing that is interesting, though, but then again, if you're in a regime change, these peak values in accumulation or in distribution don't mean as much as they used to. Quite frankly, I mean, if you look at this, that was a good low. Look at that one, that was a good low. Now that was a reasonably good low. This was a low in February, it was a new high, but you know, this is, you know, almost from a contrarian perspective, a climactic reading. But in order to confirm that, we've got to get accumulation above distribution. Until then, I'm sticking with the view that this rally is driven more by an absence of selling rather than buyers coming into the market. And that's the story. Here's another story too. Stocks above 200-day moving averages, S&P 500, and NASDAQ. It just tells you the story. NASDAQ internals, pretty darn weak. Breakdown retest. I mean, I think the risk is, the bottom line is, the risk is that, you know, the market can have more downside than most people think. Well, in this environment, what am I looking to buy? You know, in terms of sectors, I'm definitely a bull on industrials. I'm a bull on utilities tactically. I generally like technology, but the old school tech. Apple fits into old school tech now. It's a strange company. I mean, the valuations got really, really low relative to others, so it falls in a lower valuation band. Mega cap has liquidity, splitting their shares. Not that that makes it more attractive. I mean, some people think it does, but splits haven't been. According to, I read an article on IBD that splits aren't all that cracked up. But discretionary is a sector I'm bearish on. This is the first time we actually had a major rollover in the moving averages since 2009. This is a leadership group that has lost its leadership. I'm using moving averages here, it's a weekly chart. So basically any recoveries in discretionary stocks, in my humble opinion, should be sold, especially in retail. Media looks better, hotels look better, but I think the retail is the seasonal period for that is in April through October. A lot like the market, but more so. So I'm not a big fan of retail. I don't like the relative breakdown. I got laughed at all the way up by my fundamental compatriots. Whenever I was at a sector breakfast, everybody get on there with a bearish thesis. I said, I like the charts, I'm bullish. They didn't like the idea. Now, you know, they got more constructive. Of course, they were concerned about valuation, but that's what fundamental analysts say most of the time. But you know, here's another example of that, what I showed you earlier. Relative break, relative holding, absolute not. I like that. It tells me that the relative's not breaking down. It tells me that I should be buying the sector, and we actually have been, you know, for the most part throughout that period. Yes, we'll get bearish for a little while, but pound the table bullish on it, you know, once it comes back through those moving averages. You know, so we did that here and into this range. And then didn't look back ever since until now. So this is a relative breakdown that I believe is setting up an absolute chart breakdown below that level right there. Would not surprise me. Staples is interesting. It's holding a little bit better given its, you know, the difficulties of the market. What I don't like about it is this big trend line break. But what I think is interesting is trading range. We're at the range lows. This is a secular bull market on an absolute basis. On a relative basis, there's no sustained leadership. One thing I don't think you're hearing anywhere else, maybe you are, I think this sector is more tied to EM than it is to defensiveness at this point. Why do I say that? Because the EM ratio since late 2013 versus the S&P lines up really, really well with the Staples ratio from late 2015, meaning that they have moved in lockstep. So when Staples started to bounce, or when EM started to bounce, then Staples started to bounce. So there's a lot of exposure with Staples and emerging markets. So I think there's something different going on here. Yes, if the market falls apart, sure, you're going to buy Staples names, and maybe if emerging market rolls over, that will work. But I think what people aren't saying is, if this market is truly about going into things that haven't been working and away from things that have been working, EM has benefited from that, at least tactically. Long term, I don't like EM, but I think that has been a driver of this, more so than defensive characteristics. When you go into energy, tactically, I think this is a very bullish sector. I think we're in the process of negating this relative breakdown. Hasn't been confirmed yet. Again, this has been a tough sector for me because I was bearish on oil last year to give the relative chart, and that worked. The one thing that this chart doesn't tell you is that last year you could have done really well in energy by holding, anything that wasn't ExxonMobil or Shell. I'm probably simplifying that a little bit, but generally that's true. So the bottom line is, when you're looking at sectors and how to gain an edge, it's top down, it's bottoms up. Top down, this is relative weakness. Bottoms up, you look at the stocks in the sector, a lot of small cap names are doing really well and breaking out last year. So basically what it told you to do was buy the equated, sell the cap weight. Buy small caps, sell the large caps. I think that's reversing now on the back of ExxonMobil, Chevron, ExxonMobil and Schlumberger more so than Chevron. So there's a lot of good-looking charts in this space. This relative ratio looks a lot better now. It's up to here, the moving averages are starting to curl up. So I think this is what we're set up for in energy. Relative outperformance for a few quarters. So I think if you're looking for an opportunity, energy may help. Now the question is this really all just about the Crimea affair? I mean, we'll see. But if the market's going more mega cap, this stock has probably 40 to 50% of its members mega cap. 3 stocks probably are close to about 50% of it. This brings you to financials. Financials I'm worried about. Relative ratio starting to roll over. I'm watching 45 on Citigroup like a hawk. So the risk is if this breaks down, this follows. So financials, within this range, now to be perfectly clear, I did have a tactical call on this group coming off this relative low. Because it looked like it was starting to break out from the double bottom. Now obviously that double bottom is not working. So this is the stop loss on that basis. But it's also a signal to go short energy relative to the market. Why? Because your moving averages have rolled over. The short-term one is below the medium-term one, and the medium-term one is below the longer-term one. So that is what I'm taking on. So this is something that you can think about, as a potential idea. Relative. This is just bigger picture stuff that some people find interesting. It's basically technology and financials. This is the low from 2002 for tech, but the 2009 low for financials overlaid. So you can see two things going on. You can see financials breaking out. Tech also broke out too. The difference is no breadth confirmation in tech. However, financials have a very strong supply line. So the bottom line is, I don't think financials reach us at the lows. I think they can probably hold well above the lows. But again, looking at that relative ratio doesn't look all that great. Here's some other charts of financials. Healthcare is a mixed bag. Actually, this looks viable in here. More so for pharma. I do it with pharma. I would not do it with biotech. Pharma has the same pattern. The risk is this can lag a little bit relative to pharma. But generally, this is not a bad chart. Basically, what you're doing is you're correcting within an upward market. A month from now, if you're decisive below this, that idea was wrong, but I go with the trend. And it's worked. It's worked in here, worked in here, worked in there. and the absolute chart. Now this is interesting, because the absolute, the relative, wasn't confirmed in the absolute in this trend. So that, I remember when this was going on, I was more neutral on healthcare because the relative was overperformed. We got more bullish here. And that worked because there was a correction in 2012 where we outperformed the whole healthcare. And then, again here, this wasn't enough to get the return. That was a double bottom and we broke out and we were off to the races. Right now, as of this printing, it's a good buying opportunity. It actually did, this ratio did tick up. Now your stop is below that moving average. These are relative trades. Then you go into industrials. This is I think this is the correction in a bullish pattern for the sector. So I generally like industrials. Big cap, Caterpillar, Deere, Triple M. Technology is bothering. I mean, granted, this is a sector that's victimized by some high-profile stocks, but obviously, when I looked at Apple, it was up like $15, $16 and pretty money tape. So if that happens, then you're looking at this ratio bottoming right here in this range. So right here, right now, if you're trading, I got to stay long. You have enough trend line from 2006 holding. You've got chart support that goes all the way back to this high from 2003, 2004. You've got this relative chart that's in a bull market mode. So I'm going to stay with it. It doesn't, sometimes when you're a technical analyst, you have to, be objective. Is this scary to do? Sure. But has it been proven wrong? It has not. Technology has not been proven wrong. Did I do that? Excuse me. So I'm sticking with that. Materials, I think, has a year-long base or bottom right there. Same thing, turning relative trend, and outperform. That's the key. Relative support held, unlike energy. Near-term basis, energy is leading, but this is not a bad-looking relative chart. It's not so much about gold and metals. Steel actually looks pretty good. It's got chemicals. Not so much about the gold miners. Telecom is just dull, broken down. I'm not a fan. That's a big breakdown on a relative basis. I can't. It's a wealth destroyer. The only thing you get is a coupon. That's there. I'd much rather do utilities as a tactical trade. This is an improving trend. The absolute's breaking out. Relative never broke down like telecom did. So you got to go with utilities for yield. Been talking a lot, rambling. Anybody have any questions? Everything clear? Because I do cover a lot. Probably a good idea to talk about yields. Cyclical bull trend probably pulls back against the trend line breakout 2.4. I think it's a long time before yields get 4% and beyond. I don't think it happens immediately. If you look at the way yields bottomed out in the 50s, that was a 30-year bottom. Not that you need to have a 30-year bottom in yields now, but what is an initial sign of a bottom is breaking through a trend line. We haven't done that. And this is a tactical, cyclical, low, head and shoulders bottom. Maybe if you hold somewhere above 2 and then break through it, you can make a case. But right now, yields lower for longer is the view. So this is a 5-year. 5-year looks a little bit different. 30 years just going tactical here. Or 10 years right here. So I think you got wiggle room down here. These objectives are still valid. You tested 3 already, but the divergence is new equity market highs here. New equity market highs here, but the yield is low. And I think that's a problem for the intermarket line. Flattening curves. I'm not much interest in that. Commodities actually seem to be firming up more than we thought. Could be turning trend here. So this idea could be could change. Actually, we wrote about it, and one of my colleagues wrote about it today. A lot of people ask about gold and silver. I mean, I'm not enamored with metals at all. I mean, silver looks pretty bearish. Gold less bearish, but again, it's not really doing well at all. We think crude oil looks halfway decent. We like the breakout natural gas. I don't like the way it reversed, but it hasn't broken the break. It hasn't invalidated the breakout, so we kind of have to stay there. It's scary. It's scary. I can't deny this. Eventually, we think oil goes back up into this range. It's a nice consolidation. Copper is generally a bearish trend. Dollar index, the key level is right here. 79, 78, 71, 78, 60, I would call it. Euro is right in here, there's resistance. I have a hard time getting euro above 140. I don't know, it could happen. I don't think it does. That's my opinion. Yen, backs and fills, and then up there. I think that's where we're positioned. Nikkei looks vulnerable. Nikkei looks like a head and shoulders top or some sort of distribution pattern. That's probably one of the front lines right now. I think if the Nikkei breaks, chances are, the global markets won't do that well. Emerging markets aren't created equal. I mean, everybody who looks at emerging markets knows about the big trend in India. I like India, have liked India, I'm sticking with it. Chart here somewhere. That's India right there. Kospi could be trying to firm up. This is relative to the equity. So it kind of just gives you a picture of what's working in the world and what isn't. So you break in this big downtrend relative to the equity in the Sensex, or the S&P 500. Sensex actually would look a lot stronger than this, but I wanted to go with something more broad-based. I like the chart pattern. I have liked India for a while. I've liked Korea for a while. It's a broken record chart, meaning it hasn't broken out yet. But then again, when I was here last year, I was talking about Italy and Spain breaking out, and those are my broken record charts, meaning that I still think they can break out, but they haven't. But they eventually did in September, October. So I think this is a future breakout potentially. And the same thing with Hang Seng, except this relative is pretty poor. Rates remain low. Indonesia and Thailand can do well. The one thing I have pointed out in this chart book was that this uptrend line was holding. Some people actually took that as a reason to get more involved. What I like looking at is this. From a trading perspective, you've got this downward sloping trend line, rising trend line. It gives me confidence that we can get some tactical improvement. Jakarta broke its uptrend line, but I revised the channel. So, believe it or not, I did something you're not supposed to do. I drew the channel off the highs and used it to project support for the lows. It's not in the textbooks, but I find it works. So basically, I did it with the S&P also. Actually, I didn't do it with the S&P. And one person said, hey, why didn't you do it with the S&P? Because the February low held right on the channel that he showed me. This guy taught me a wrong lesson, so it was funny. And that's the story. I like Thailand, not Thailand, Taiwan. Maybe a relative turn here. First sign of some sort of decent relative bottom. This one's actually holding up interestingly too, and that's a big relative level. Sometimes when you test these big levels, you kind of have to pay attention to it. Generally, it's a terrible relative performance. This is Singapore. But it's pretty good support right here. It's held. No, I'm just showing you these things. It kind of gives you a way I try to look at stuff. Absolute relative.
Yeah, any questions?
Yeah, probably a good time.
Yes, is the report publicly available, or do you have to be a customer of Merrill Lynch?
I mean, you guys have it, so you can do what you want with it. I think I would love to.
What, your permission?
Yeah, I would love to. You guys can take a look at it. Definitely. I mean, it is for clients, but not here. So I think anybody who wants access to it, more than welcome, definitely.
And can you get on the email list for it?
Well, I mean, yeah, that's client stuff. That's harder to swing. I get pulled into. I do that sometimes, and I get in trouble. I don't want to get any more trouble. I get labeled a troublemaker enough, just by being technical analyst. Anything else?
Do you have a view of China?
Great question. China, I know is going to be under some pressure, but the problem, well, not the problem actually, but I have the H shares and the A shares. So the A share index, obviously now it's closer to B. This is, the relative is off. That's one thing. So it's hard for me to really be too bullish on it, but I mean, it's a potential bottoming process. Bad news thrown out of here, bad news thrown out of there. Second time around, hell, this bad news down here. So we'll see if bad news continues to hold support on China. That's really the only thing I can say. Just looking at this chart, I think you still got to be underexposed because this is relative. If you're an active global manager, you got to be underexposed. The Nikkei is interesting because I am more constructive longer term. I do think it's trying to turn. First sign of that would be breaking through that trend line, which we have failed to do. Second sign would be breaking through that high. One thing that bothers me a bit, this is a big base, but you've seen this before, right in here. I mean, is this the same thing where you fail miserably? You can make a case for it, right? It looks very similar, but as of right now, I like the way the volume was off of this rally. It reminded me of the S&P rally off the 09 lows. Financials outperformed drastically on that rally. They're underperforming now, but so did ours. After that initial rally, they underperformed for a good year. So I think we're in a similar position. Japan's in a similar position that the S&P was, coming off the 09 lows, and I think this is a consolidation and a move higher. But China, pay attention to H shares, pay attention to the A shares. The H shares I have back here. I mean, if the news is thrown at this market and it doesn't break down, it tells you something. A lot of bad news has been thrown out already. The market hasn't broken support. So I just got to show you this. The chart's neat, so it's not. Well, maybe I can't find it. Oh, there it is, right there. Looks a little bit better, but relative is awful. What do you do with that? It's a downtrend. Absolutely. Look at the support that's holding. So I'm paying attention to that level, and if I continue to get bottoming signs off, because every time you go down there, you form some sort of bullish reversal, some sort of undercut. In January, you had a weekly bullish engulfing pattern on the A shares. Probably did a similar thing on this. So the market has found support on bad news, and if it continues to do that, it's probably going to go up. So we'll see. That's the contrarian view of the night, I guess.
Any more questions?
Do you ever use seasonality for individual stocks as well as the sectors?
That's a good question. I can, but I haven't.
Is that available in
I'm sure. I don't know about equity. There's probably something on there that you can run, like the SEAG function. It might do it, but it only goes like 10 years back or something like that. I mean, seasonals, you need more data. Yeah, it's kind of something I think you got to build on your own for stocks that have been around a long time.
Anything more? If not, we have about 40 minutes to the tube strike.
Yeah, those twos.
I know. In any case, if there are no more questions, I would like to thank each and every one of you for attending today's MT monthly meeting chapter with Steve, who was kind enough to travel to the States and give us this interesting presentation. And hopefully we'll be seeing you at the next MTA monthly meeting. Thank you all very much for attending.